How to invest in stocks for beginners. Investing in stocks and seeing returns on your investments can be complicated, but not all the work has to go into researching stocks, specifically how to invest them. This blog article tackles that point with 3 important topics which often get overlooked by beginners. Explain what investing in stocks is and how it differentiates from making a financial investment. Investing in stocks is unlike most other types of financial investments because it involves buying and selling shares in a company. When you buy shares, you are essentially becoming a part of the company. This entitles you to share in the profits and losses that the company experiences. Conversely, when you sell your shares, you are cashing out and getting money back from the company. Whether or not you make money on a stock depends on many factors, such as the price at which you buy and sell the shares, how well the company is doing, and whether there are any structural changes taking place within the company, such as an acquisition. Some people invest in stocks because they think they will grow in value over time. Others do it to get access to reliable income. No matter why you invest in stocks, it's important to do your research before making any decisions. What is an investing scenario? In order to truly understand what it takes to become a successful stock investor, one must first understand the investment scenario. When you invest in stocks, your money is put into a company or securities and monitored over time. There are 3 primary investment scenarios: growth, value, and speculation. Growth investing entails buying stocks of companies that are expected to experience substantial increases in their stock prices as their growth prospects warrant. Value investing is all about buying stocks of companies with good underlying fundamentals, earnings, dividend payout, etc., and holding them until they reach their intrinsic value. Speculation is when an investor purchases shares of a company simply because they believe the price will go up, a buy and hold mentality. All 3 scenarios have benefits and drawbacks, so it's important to understand what you're getting yourself into before diving in. Some common types of stocks to invest in include industrials, such as Coca-Cola or General Electric; financials, such as Citigroup or Wells Fargo; healthcare, such as Johnson & Johnson or AmerisourceBergen; consumer goods, such as General Mills or Procter & Gamble; and technology, such as Apple or Facebook. If you stick to a few core holdings, then you won't have to worry about keeping up with the market too much since everyone else isn't tracking all available indices. There are also index trackers that automate and customize how each ETF moves within its respective index. More an investor has shares of less demanding type of stock being bought, more open to manipulation and greater dependability one will have in making his/her own portfolio decisions. This is particularly true if sell-stop order is not used by the investor placing such order. Investors in option strategies usually hold the positions they buy for some period. Long-term investing strategies. Investing in stocks is a great way to build your wealth over time, but it's important to do your research first. Here are some tips on how to invest in stocks for beginners. 1. Start with a diversified portfolio. A balanced stock portfolio includes a variety of different stocks, including large and small caps, dividend-paying stocks, and growth stocks. This way you'll be more likely to find success no matter what the market does. 2. Don't overreact to day-to-day movements. Don't trade stocks based on insignificant news stories or rumors, focus on long-term trends instead. 3. Don't inflation-proof your investments. Be aware of events that could inflame prices such as sovereign debt crises or recessions. These could cause your investments to lose value rapidly. 4. Put money into high-quality companies. When investing in stocks, look for companies that have good fundamentals, meaning strong financial stability, leadership positions in their industry, and consistent growth prospects. 5. Stick with a well-diversified investment strategy. Even with the best research and investment skills. Micro-cap stocks, small-cap stocks, intermezzo, retail products. Retail products are those items that people can purchase in physical stores. These products can be items such as clothes, food, and electronics. Retail stocks are typically considered to be riskier than blue-chip stocks because they are less well known and are therefore more susceptible to volatile prices. However, there are a number of factors that can help to mitigate this risk, including strong management teams and a track record of profitability. How to read a financial review. 1. Start by understanding what a financial review is and why it's important. A financial review is a document that investors can use to make informed decisions about which stocks to buy or sell. 2. Next, read the risks and rewards associated with each investment. By doing so, you'll be able to identify which investments might be worth your time and money. 3. Finally, consider your investment goals and map out a strategy based on those intentions. This will help you stick to your plan and minimize risk while maximizing gains. SWOT analysis and company profile analysis. There are a few things you should keep in mind when investing in stocks. One of the most important is to do your own research, and make sure to read the company's financial statements. You also need to understand what factors might affect the stock price, such as economic conditions or new regulations. Finally, it's important to have a strategy for how you'll invest your money. SWOT analysis is a term used in business to describe strengths, weaknesses, opportunities, and threats. You can use SWOT analysis to see where the company falls on the spectrum of these factors. For example, a company with many strengths, such as strong cash flow, may be less vulnerable to threats, like competition from a rival with lower costs, while a company with few strengths may be more vulnerable to threats, like a recession. Thanks for watching. See you on the next episode.